Thank you very much for giving us a slot today. So Finclusion is building a neobank for Africa. Ultimately, for us, the big challenge in Africa we see is that customers live paycheck to paycheck. Mobile phone penetration is going up, the working population is growing rapidly, but there is continuously limited credit available to customers in sub-Saharan Africa. There is a 20% private credit to GDP penetration in Africa, which is 60% in other emerging markets. Credit card penetration sits at about 9% across the continent. Formal credit lines aren't available to over 400 million of working sub-Saharan Africans. And the credit that is available at predatory rates of 50 to 100%. And that's not per annum, but it's per term, which can be as short as a single month. So what's the solution? The solution is a credit-led growth strategy underpinned by superior credit risk modeling. We do all our credit risk modeling on the back of transactional features, behavioral data. We take transactional features from bank statements, from mobile money statements, because there is transactional data out there. We've scored with our technology over 3 million loans. And in total, including predecessor entities, given out over $1 billion worth of credit volume into the continent. So what's our initial core offering? We focus on payroll and earned wage access. Why? Marketing in Africa is very expensive. We want to market to a captive audience. Focusing on earned wage access allows us to market through employers, through partners, where we know that all of the underlying individuals need credit and can afford to have credit. Our products are focused on those with income. We can't address the ultimate poverty level with people earning $1 or $2 a day. But anyone earning upwards of about $200 a month falls within our target audience and is within the clients we can provide credit. Once we give out those additional credit products, we focus on adding other products, be it insurance, be it also credit finance for products and goods. There is an incredible limitation on the access to services and goods across the continent. So earned wage access in our current target markets in South Africa and East Africa, there's a working population of about 80 million individuals. Once we go into West Africa, there's a further 60 million working individuals out there. In total, that's 150 million people that easily can afford a loan of $1,000 upwards each, which means that on an annual basis, that entire market is a $100 billion plus market across the continent, of which we only have to capture a very small subset. The same applies in buy now, pay later, where people need goods and services. People need access to products because it's not just about giving them credit, it's about giving them access to things they previously did not have. So how do we go to market? We go to market with employers. We focus on hospitals, schools, formal retail stores, as well as the mines. All of these have employees upwards of 200 employees, which means that it's easy for us to get to reasonable scale within time. Ultimately, our long-term vision is that we want to build a neobank for underserved Africa, which means we start with lending, loans, earned wage access, buy now, pay later, but we'll grow into payments, deposits over time, as and when customers need services. But today, we truly believe the gap exists in where there's credit offered and where there's credit needed. Since we've started building, we officially opened Finclusion in 2018. We've come a long way. We've opened operations in South Africa, Eswatini, Kenya, Tanzania, and Namibia. And we've served 250,000 clients, built up a $17 million loan book to date, and are currently up to about $2.5 million monthly disbursements, which is a doubling of about a year ago. We've kept our actual loan book flat over the last 12 to 18 months, which was really a function of where the market was. Unfortunately, in COVID, a credit-led strategy meant we had to slow growth because not everyone could afford credit. But right now, we've just closed a $20 million funding line from Lendable, which allows us to double our loan book over the next 6 months and grow it from there further and further. As and when we grow the loan book, we'll basically follow a general strategy. That means initially we focus on payroll and earned wage access, provide employees initial loans on the back of their salary, and allow them to access that credit easily and quickly. We then subsequently add merchant-driven distribution where we allow people to buy products and services through credit, either with interest rates or without, but always focusing on affordability. And finally, we'll basically add SME lines, where we'll provide working capital facility, those of our partners that still need it. In our different geographies, we're at different stages of maturity. In South Africa, we have an active payroll and earned wage access book. We currently don't do SME lending, but in Kenya, we have the full suite of products live. And I think ultimately, what truly sets us apart from many of the others in the industry is the amount of loans we've actually successfully granted to date, the amount of applications we get, and the amount of data we've gathered on 250,000 clients. Because on all of these clients, we know what they earn, we know what they spend, and we know how they spend it. And for us, the future of financial services is not just servicing people with credit, but ensuring we service them with credit for those products and services that they truly need and want. And that for us is where we think we can grow over the next few years. Thank you very much.